With fundamental analysis, and this is lecture 5, and from my textbook is chapter 12. In your latest edition is chapter 13, equity, valuation. So, what we're doing today is we focus on valuation. Valuation is the primary topic of fundamental analysis. So, fundamental analysis is about valuation, and today's focus is on equity, which means stocks. So, section number 1 is valuation by compromise. Unfortunately, honestly, the whole section is very incoherent, difficult to understand what they meant to say. It's not clear. They just write stuff and it's not clear. But the idea of comparables, you look at a relationship between price and some variable So you look at the relationship between the price of a stock and some variable which we can observe and make inferences about the overall valuation. Now, where do you look the variable? Back in the good old days, well, it's even today, there is a database called Edgar, which I will not discuss. Now, or at least I've been using it for a long time, is on Yahoo Finance, and back in the old days people like to use value market. So what these three represent is the sources of information, sources of data. Alright? So what we're trying to do here is basically compare the market price to some variable, company variable, which is typically coming out of a statement or some other statistics. Alright. Let's see what else. One of the such key variable is do we think we should close these windows because it's getting too noisy? We take a look at book value. What is book value? This is the accounting value of the company. When we say book value, this is the accounting value of equity in the company. So, you have a balance sheet, you have an asset side, and you have a liability side. The right-hand side will have liabilities and equity. The value of equity we call book value. So, what we want to see is, let's say, the book value per share and compare it to the price per share. And the price per share should more or less be close to the book value per share. And I'll be discussing under what circumstances there will be difference and how it will be determined. So this is one basic comparison. You compare the price to book value and see how much the price is above or below the book value. The idea is that book value will be representing a fair value of the company. Well, the problem with the book value is that it's accounting. And if it's accounting value, it is subject to arbitrary rules. How you depreciate your real assets. If you depreciate faster, you will be getting lower earnings or whatnot. If you're, let's say, using FIFO or LIFO, you're going to be getting different values. So in general, book value has a lot of arbitrariness into it, as any accounting variable. Depends on accounting methodology, and therefore book value is not a very perfect measure. All right.
Market value is better, right?
Well, that's the question. What is a market value? And market value is simply the price of shares. So let's just define two market value to make sure you understand it. What market value? Market value, and I'm using 3 dashes by definition, simply means price per share, price per share times number of shares, outstanding shares. Alright? It's simply the number of outstanding shares times price per share. But the point is that this is already this price.
Sure.
So, we can't compare market value with the market price because it is the same thing. What we're trying to do is to compare the market price to something else in order. The whole thing of valuation is simple. To determine whether the stock or the asset is overvalued or undervalued. Overvalued or undervalued is determined by what we call or determine the concept of intrinsic value. Intrinsic value. Intrinsic value, which is sometimes called fair value.
Is the market?
Well, no. Intrinsic value is what is the asset worth based on its present and expected future cash flows. According to intrinsic value and fair value, this is the net present value of all cash flows.
Which is what it actually deserves. It's fair value. It's different than market value, right?
Correct. That's the point. The point is market value is simply the price today, 21.73. This is the same as oil. King Abdullah things, the value is 75, but yesterday you get to trade at 68.
Wow.
Well, the point is you have a market value, and the market value does not coincide with the intrinsic or the fair value. If the market is efficient, market price will coincide at all times with intrinsic value. If the market is efficient or very efficient. Now they say, well, if the market is efficient, you can't expect it to coincide at all times. But you expect the price to tend to and to track the value. The way it works is like a moving target. You have the fair value moving up and down as we discover new information, and the market price is tracking, getting it closer. But as soon as it gets closer, the fair value moves down, the market price tracks down. Not perfectly, but the idea of market efficiency is that the fair value will tend towards, or the market price will tend towards the fair value, all right, or the intrinsic value. So the objective of fundamental or equity valuation is to determine what is the intrinsic value of the stock, then to observe today what is the price. And if the price is significantly above the intrinsic value, then it is overvalued. price is significantly below, then it's undervalued. And ideally, you will be buying, we go long the undervalued asset, stocks in this case, and you will go short the overvalued assets. And you expect over time that the market will discover this, which we call mispricing. Mispricing. So mispricing is a significant deviation of the market price from the intrinsic value or the fair price, however we compute it.
How long do you do this process takes?
How long does it usually process takes? Well, if the market were truly and genuinely efficient, it should take a few minutes or a few hours, no more than possibly a few days, as the market needs to digest new information. Sometimes you will have accounting statements, and accounting statements will have significant amount of complexity. Sometimes people will need to take the weekend to read the fine prints, we call it the footnotes, to digest it, to analyze it, to figure out what's going on, to figure out the prospects. For example, for oil, this is not part of this chapter, you got to figure out the growth of different countries, maybe Japan, maybe Singapore, maybe US, maybe the Middle East, maybe Western Europe, Eastern Europe. And once you figure out overall what's going to be the global economic growth, which will represent demand for oil, then you got to figure out the prospects for short and mid-term supply and, begin to do this. So sometimes it can take weeks or months. But in the real world, you can actually see potentially assets mispriced for many, many, many years. That's perfectly realistic. And the market will get it, or market analysts will be getting it wrong most of the times, which again simply says that the markets aren't very efficient. Well, one of the best examples ever will be bubbles, dot-com, telecom bubbles. Some people will say that the dot-com, telecom bubble wasn't even a bubble at all. It was perfectly rational expectation, and people were factoring in the extraordinary growth of all of those dot-com and telecom companies. And they were forecasting the growth, and the mere fact that they crashed simply proved that these stocks were extremely risky. So they're saying, well, if these were giving 30, 40, 50% return, it was for a perfectly good reason. And the perfectly good reason was that these were extremely risky. And 90 or 95% of them really crashed, all right? But that's the idea of mispricing. In other words, in a bubble, some people say, well, it wasn't really a bubble. But I would say, of course, 3, 5, 7 years, people believed incorrectly and would misprice the asset incorrectly. Now, you just witnessed in Dubai real estate bubble, in US a real estate bubble, and people believed foolishly. Now we know that 99% of market participants were wrong. Now we know they deluded themselves. Now we know they had illusions about, becoming rich from real estate, and this qualifies properly as a bubble, all right? But the idea is that some time mispricing will last for 3, 5, 7, even 10 years. All right, well, think of it this way. Even if today oil is 68, and it was 9 years ago $10, oil going up 7 times simply means that either now it's extremely overvalued, or back then was extremely undervalued. Now it's not very real to assume that the fair value or the intrinsic value of oil has increased 7 times. Somehow our intuition does not allow for such an extraordinary increase in valuation. Well, we know from history that food usually doesn't, price and value of food doesn't go as fast unless in times of war and disaster, epidemic or whatever. We know housing and real estate doesn't go up 5-7 times normally historically. Stocks usually, in other words, increasing prices 7 times for 5 or 7 years is extremely abnormal historic, extremely rare. And common sense just tells us the intrinsic value probably doesn't go up 5 or 7 times. This means either now it's mispriced, or 7 years ago it was mispriced, or it may have been mispriced all along. Yeah? And maybe the fair value is easily 200 or 250. Alright? So that's what fundamental analysis is. This deals specifically with stocks for now. Alright, so you can use book value. Number 2, you could use so-called liquidation value. This is simply the value of the company if the company is liquidated today. To liquidate today means that you slice it in pieces and sell each piece at the market price. If you've watched Wall Street, the movie, this is what Gordon Gekko was doing with that company, where he would slice off and sell the airplanes to one company. He will take the airplane hangars and sell them to a separate company. So he will get bits and pieces and sell them for the best that he can. And he will pay off all liabilities, and whatever he has, he will keep as a corporate raider. He would actually keep the pension plan, which was back then, within the context of the movie, the pension plan was overfunded. What does it mean, pension plan to be overfunded? Means that the company has been putting into a pension plan money, and whatever has been putting the money at a certain rate has accumulated more assets in the pension plan than are the currently projected liability based on the current assumptions on interest rates and everything else. Alright? So the idea was once he liquidates everything, he will cash in the overfunded portion of the pension fund, which was liquid. So he's going to take it in the form of cash. Alright, so liquidation value is simply the value of the company if it was sliced into pieces. Well, what will be the liquidation value, let's say, of a hospital or this university? Well, it's going to be mostly the building as a real estate and machines and equipment, let's say the board, the lamps, the computer projectors, the tables, the desks, and stuff like that. In other words, in this university, in terms of assets and in terms of liquidation value, has very, very low value. Doesn't mean university is not valuable. It means that the value is coming from human capital. The value of the university is or are the professors with their knowledge to generate income by overcharging the students. Right? This is how the university makes a profit. The university makes a profit by charging a certain price. These are the revenues. And there is certain costs, salaries and other operating costs. And the difference is a profit. And the profit will be reflected in the full value of the company, but not the liquidation value of the company. In other words, the value of the university is mostly intangible. Right. And the same applies for hospitals. So intangibles are the primary value of a university. Question?
How long does it take to liquidate the asset counts and the liquidation?
Okay, so what we do here is we don't actually liquidate the company. There is no actual liquidation. What we do is we value what the company will be worth if liquidated. So liquidation value is a hypothetical situation. If we try to sell the airplanes, what we'll get? Well, we'll have 10 airplanes, 20 million each, so whatever the number is. We have these hangars and storage areas, whatever they are, you know. So all you do is you provide a hypothetical value. Well, when do corporate raiders step in and buy a company? And the answer is sometimes when the liquidation value is above the market value. This was the case in the Wall Street movie, right? The idea was that, okay, you take the company, slice it into pieces, sell it out, meaning liquidate it, and it will be worth more than the current market price. So, liquidation value provides what we call a floor to the market price. This simply means that as soon as the market price falls below this value, no, corporate raiders, like Gordon Gekko in the movie, will start buying shares, start accumulating shares, and they will drive the price back up. And if the price doesn't go above the floor value, they will buy enough to take control of a company, take over the company, and decide, being in control of the company, to liquidate it. Alright? So this provides a floor. Let's see what else. The third type of variable is called replacement cost. Alright, so replacement cost is simply the cost, the money that you'll need to rebuild it if you want to rebuild it from scratch. So the replacement cost of this university will be, again, the building, machines, equipment, computers, desks, boards, etc. But just like with universities and hospitals, the replacement cost is a lot more than that. The replacement cost will be hiring the professors. Well, hiring the professors is not only paying a salary, it is providing attractive opportunities for the professor, career opportunities, providing attractive lifestyle for the professor, alright? So, providing good schools for their children, etc., etc. So, you need to have the professors. But a value in a university, as well as in a hospital, is the so-called business process. Can students enroll quickly and efficiently? Well, will students be admitted quickly and efficiently? Will the university take their money quickly and efficiently? In other words, you want to pay them, are they going to be able to, do the computations and whatnot? Is it painful? Is it painless? Will the university provide high-quality service? Will it provide a wide variety of courses? Will it provide good flexibility? In other words, the university, just like the hospital, provides a service. And the quality of the service depends on two very different things. One is the quality of the staff, and the other one is the smoothness of the business process. Is it easy to drop one course and add another course? If you decide to add a course in week 2, will they let you do so, or say, no way? In other words, is the institution service-oriented and has the process? If the student, or meaning the sick person in the hospital, needs something to be quickly and efficiently taken care of, alright? You need business processes. A bulb of the projector blows up. Does it take 2 minutes, or 2 hours, or 2 days, or 2 weeks, or 2 months, or 2 semesters to replace it? That's part of the business process, because the bulb of a projector is not about the money anymore. It costs $10, $5, $20, whatever. It's cheap. It's the business process which is extremely important. Question?
Is the depreciation considered?
Yes, depreciation is considered part of the replacement cost because, usually what you want to do, replacement cost includes the same quality. So you will already factor in the depreciation in here. But the problem is that the replacement cost is not a really good measure because you have business processes which, if they're fluid and working well, will add value to the company. You have this thing in management science called corporate culture or institutional culture, where people are highly skilled, they're flexible, they can respond to market demands and whatnot. These add value. In other words, you have, besides this so-called intangibles. For example, Microsoft has an extraordinary amount of intangibles of computer programmers, skills and business processes and whatnot. Many pharmaceutical companies have extremely high level of intangibles. This is what Saudi Aramco is trying to develop over the last couple of decades. It has. Most of Saudi Aramco's value is tangibles. This is the oil underneath them, right? It's mostly there. But what Saudi Aramco is trying to do is technology, business, processes, expertise, computer sophistication to be able to find out where it is, and a lot of, in other words, trying to add value by intangible. Well, how will intangible add value to Saudi Aramco? Two fundamentally different ways that will be, in the long run, reflected in the bottom line. Number one, better efficiency. And better efficiency means lower cost per barrel. Whatever the price is, it won't be costing $10 to Saudi Aramco, it will cost $7. So the $3, which is improved efficiency, will enter the bottom line. That's one way. Another type of intangible is better, being able to better extract more oil out of the ground. I mean, you don't think for a second that when you have an oil well that Saudi Aramco extracts 100% of the oil. No, they extract 70 or 80% of the oil. Other companies extract 65. So if Saudi Aramco is able to increase the extraction level from 70 to 72 or 74, these 5% more will represent millions, possibly tens of millions of barrels of oil extra that will be a result of the intangible. In other words, the intangible will be eventually down the road converted into barrels of oil, and you have to properly discount those through the net present value computations. Alright? Is that fairly clear? Replacement cost. So these are three fundamental methods. They're not great, but they give first ballpark ideas. Alright? Let's move on to the next section, which is, and which I've covered a little bit, intrinsic value versus market price. So, section number 2. Intrinsic value versus market price. Alright. So, we begin the section with holding or expected holding period return. This is fairly straightforward. Expected holding period return is simply the current income, the income during the period, plus the capital gain. Alright? And then you take this and you annualize it. So for 3 years, you'll be getting some income current, you're getting some capital gain, and then you annualize it, because you may have gotten it for 8 months, or you may have gotten it for 3 years. You properly annualize it. Nothing really there. Now, the next concept is that of expected return. And when we say expected return, we definitely mean always annualized. So you have a stock, you have a bond, you have real estate, you have oil, you have any assets, any investment asset, it will have a certain expected return. That's fairly straightforward. This is what you expect as current income, and this is what you expect as capital gain. That's the one part of the equation. The second part of the equation is that you will have required return. Right, what's the question, guys? Holding period return. So this is the return which you get for holding the asset throughout a given period. 3 days, 3 months, 3 years, 30 years, whatever the holding period is. So this is the holding period return. This is coming from portfolio theory, if you remember very early on. And if you're going to be investing, you'd better have an expectation of what you expect to gain or do. In other words, what will be your return. And then you annualize. So the expected return is simply annualization of the expected holding period return. Alright?
So do you mean annualization or analyzing?
No, annualize means to convert to 1 year. So for 8 months, you get, let's say, 6% return. On an annual basis, it's going to be 8.2 or 8.4, right? For 2 years, you expect to get 25%. So the annual will be 12. So you convert the return to 1 year. You standardize. If you want to be comparing, you need stocks, bonds, real estate, any investment, you'd better convert it to 1 year if you're going to be comparing. Otherwise, you can't compare. In other words, to compare returns of two assets, number one, you need to make it to the same year, and then to compare also risk. Now, what about required return? Required return is what you would like to get or want to get for putting your money at risk. So, required return will be affected by
what do you want?
Yes, what do you want for the given risk? For the given risk. So, expected, or sorry, required return is dependent on the risk, and sometimes they write it in some other books, not in this one. They write it, for example, in my other financial institutions, what they call perceived risk. In other words, what the investors think today is the risk.
So, the required return is higher than the zero risk return?
Yes, the required return is always equal or higher to the risk-free return.
Okay. It depends on the person, or you have...
No, it depends. I already wrote it on the board. It depends on the risk of the investment itself. If you are more risk averse, for example, it's got a certain amount of risk. If you're more risk averse, don't invest in it. That's it. The person will not invest if he is more risk averse. If he's less risk averse, he will invest. Risk is something which is objective, how the price flows around.
I mean, for example, an industry has a required return.
What, an industry? Yes, that's what, look, I already said it. It is shockingly simple. It depends on the risk itself. Of course, one industry will have very high risk, and of course another industry will have very low risk. Last lecture, I already explained some factors that determine the risk of an industry. operating leverage, financial leverage. Of course, the construction company will have one risk. Of course, a car maker will have a different risk. Pharmaceutical will have a third risk. Food industry will have a fourth. So each industry has its own inherent risk. Now, each company within an industry will have its own risk, depending on whether the company is even more leveraged or less leveraged, whether the company is favorable, has favorable competitive advantages or competitive disadvantages, or whether the company has proper government protection or has no government protection. It's properly called government relations, right? So all of these things will determine the risk of a company. That's all. And the risk will determine the required return. Of course, we say perceived because for real estate, 2004, 2005, 2006, people perceived real estate to be practically risk-free. Nobody, really, 99% of Americans did not perceive any risk. They considered real estate to be ultra safe. They considered it to be no-lose investment. So, of course, we all know better, and now they know better, but back then they perceived it as risk-free. So, at the time of valuation, they perceive it to be relatively riskless. Alright? So, what we want to do is we have some expected return. This is based on the capability of the asset to generate revenue, to generate income. For the stock to generate profit and be able to set aside the profit and pay out as a dividend. For a real estate to be able to generate rent and set aside as again income or dividend and the required return. So this is another basic relationship in finance. And for example, if the relationship could be less than or greater than, if you have the relationship where the expected return is higher than the client return, you have the asset to be undervalued. Alright, so it's good to buy because it gives you more than what you expect or require as a compensation for the risk. So this particular piece ties in with portfolio theory. Usually risk will be measured by capital asset pricing model. However bad it is or however good it is, this is one way to measure risk. Of course, this is exactly what Warren Buffett does, even though he does not necessarily use standard deviation and capital asset pricing model. So every investor, every great investor assesses risk. You must have. No great investor in the history has ever invested without proper assessment of risk. The question is, how do you do this? And Warren Buffett doesn't use capital asset pricing model. And Peter Schiff certainly doesn't use capital asset pricing model. And Jim Puplava doesn't use capital asset pricing model. But they all try to assess and evaluate risk. And they sure require to be compensated for that risk. Alright? Now, most modern day money managers use capital asset pricing model. Why? Two reasons. Number one,
they were taught this way.
Everybody studied it in business school. It is the dogma, modern day finance dogma, number one. Number two, with modern day computers and software, it's easy. You plug in the numbers in the software, you estimate the covariance or the correlation, boom, it's done. Anyone can do it these days. You just plug it in. So it requires no special skills. So who does it? 25-year-old kids who have degree in architecture or history industry or something else and went through in 2 years of a business school. When they're out of business school, they get into the finance Wall Street industry, and that's what they do. Why? Because it's simple, because it's easy. All right? Back to this stuff. So, required return, intrinsic value, undervalued. All right, so when we say undervalued, sometimes they use the word underpriced. Underpriced. And by underpriced, we mean the same as undervalued. We mean that the intrinsic value is above the market price. Now, what is important to understand? That the intrinsic value is the discounted free cash flow, the discounted cash flow. And the discount factor is the required return. So, this intrinsic value is computed by using this required return. Alright? So, when we compare market price to intrinsic value, this is equivalent to comparing expected returns with required returns. It is equivalent. These two approaches will give effectively the same result. And the reason is that here the required return enters the formula of intrinsic value over here. Alright? And the expected return enters the formula of intrinsic value over here. Alright? Let's see what else we have. Alright.
The opposite. The opposite.
In what sense opposite?
Overpriced. I mean,
If the intrinsic value is less, then it's under, then it is, if the intrinsic value is less, the market price is lower, overvalue, my mistake, Alright, and the last concept of this section is so-called market capitalization rates. That's, again, I gotta use red because it's a concept. Market capitalization rate. So, the market capitalization rate is essentially the expected rate of return of the security. So, let's provide an example. Expected rate of return will be, let's say, 10%, and the required rate of return will be 9%. So, if we have certain dividends, certain income, the market capitalization rate is the rate which essentially equates the expected future cash flows, is that discount rate which equates the expected future cash flows with the current market price. So, this is for the bonds equivalent of yield to maturity. Yield to maturity. So, the yield to maturity is the discount factor for a bond, the discount factor which equates expected future cash flows to the current market price. Well, the market capitalization rate is the discount factor which equates future cash flows, that will be dividends or earnings, to the current market price. So, market capitalization rate is what currently the market rewards market participants given the expected holding period returns. So, it may be the market capitalization rate is above the required rate of return, maybe it's below. If the market capitalization rate is above the required rate of return, it means one of two things. If it's above, it means that either the asset is undervalued, or the required rate of return, the risk, was not assessed properly. In other words, either the security was mispriced or its risk was mispriced. In other words, you have mispricing, and when there is a divergence between the two, either the price was mispriced or the risk was mispriced. Simple as that. And this concludes section number 2. Now we continue with the concept of dividend 12.3. So in my book it is 12.3. In the new edition it's going to be 13.3, dividend discount models. Essentially, modern finance and equity valuation relies on dividend discount models. It's very simple. In the end, because stocks have no maturity and they can live forever, the value of the stock is simply the present discounted value of all current and future expected dividends. That's it. And they're discounted with the according or the appropriate risk adjustment. So the risk adjusted, discounted future dividend flows. That's the modern version of dividend discount models. Question?
I don't discount the capital gain, which is at the end of the period.
Yes, we don't discount the capital gain, which is at the end of the period, and I may provide a basic derivation, but the idea is fairly simple. Present value 0 is simply equal to current dividend plus present value 1. Alright? Well, present value 1 will have some discount, right? Now I have present value 1 will be dividend 1 plus present value 2. Alright? And now present value 2 will have dividend 2 plus present value 3. Now, what is present value 1? This is actually priced in 1 divided by or discounted, right? Present value 2 is price to discounted. So, what I can do now is say dot dot dot. Now, this is a little simpler derivation, but it's mathematically correct. So I'm not using the discounting right now yet. I'm just saying present value 0, present value 1. Alright, present value 1 is going to be the next price, and I'm discounting it. But I don't need to do that. Here's why. So all we do right now is sum, and we say PVN is equal to PVN plus 1 plus dividend. Dividend, that's my mistake. Sorry, guys. Dividend n plus 1. And now I sum up. When I sum up, what happens is PV1 plus PV0 plus PV1 plus PV2 plus PVN plus dot dot dot. Let's write it out. PV0, PV1 plus PV2 plus dot 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 plus PVN plus dot 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 equals two things. Dividend 0 plus dividend 1 plus dividend 2, right? Plus dot dot dot, and then I have plus PV1 plus PV2 plus PV3 plus dot dot dot. Alright? So now we have cancellation. This PV1 cancels with this PV1. PV2 cancels with this PV2. PVM cancels with PVM. And everything cancels out.
Unless PV0 equals
PV0. So,
zero.
okay, here's what I should have done. Here's what I should have done. I should have said dividend 0. I should have said now PV of dividend 1, PV of dividend 2, PV of, this one is PV of dividend N, alright? So I should have said here PV of these dividends, alright? That's how I should have done. And now becomes that present value 0 is equal to everything else disappears. All present values disappear. The only thing that we have is
Present value 0.
Of dividend 0 plus
Initial.
dividend 1 plus
Initial.
dividend 2 plus dot 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 till the very end. Alright? Well, present values are additive. It simply means now that present value of dividend 0 plus present value of dividend 1 plus present value of dividend 2 plus dot dot dot.
There's another
Alright?
thing.
Huh?
There's another thing. It's plus PV n plus 1.
Yeah, well, the point is, I leave it up to infinity. So, when I allow it up to infinity, this cancels with this cancels with this cancels with this cancels with the next. So, if you leave it finite, the last, we call this terminal value, we must factor it in. But if you let it run to infinity, 100, 200, 500 years, then PVM plus 1 disappears. It vanishes. If it's long enough, let's say 1,000 years from now, its value is going to be approaching 0. Alright? So, now what is this PV dividend 0? Well, this becomes now your too familiar formula, which is dividend 0 plus dividend, say, present value of dividend 1 is simply dividend 1 divided by 1 plus, let's say, R, which is the required rate of return, to the power 1 plus dividend 2, 1 plus R squared and dot dot dot. And it becomes simply the familiar formula for present values. And we're going to about 10 more minutes to finish for today. So, this is basically the dividend discount model. Alright? So, now you can do a number of things. Let's leave this here. Let's pause for a minute. We have now 4 basic cases of the dividend, or 3 number of basic cases of dividend discount model. First one is no growth model. This is, it doesn't have an official name as basic, but it is the basic. No growth model means the company does not grow. If the company does not grow, this means no growth model means that earnings do not grow. And this means that dividends do not grow. And this necessarily means that dividends are constant. Alright? Dividends are constant. And if dividends are constant, then the formula, present value formula, becomes a dividend plus dividend plus dividend plus dividend. It is the same number, and it becomes simple geometric series, and then it becomes the same as a perpetuity or a constant. Alright, so it effectively becomes identical to a bond which never matures. And if you remember in that particular case, the present value will be simply equal to the dividend divided by the R, which is the required rate of return, which is, let's call it risk-adjusted required rate of return. Now, it is important to understand that this formula is identical as a government console, but the R is different. In a government console, which is historically issued by the UK government, the R will be representing the risk-free interest rate, while for a stock it will be representing the risk-free plus the risk premium. Alright? So we can write it as dividend divided by risk-free plus the risk premium. For a console, the risk premium will be 0. Alright, so that's the first case. This is the simplest case, and we use it as a benchmark. As a second benchmark, we use the constant growth model. Constant growth model simply assumes that company grows at a particular rate, maybe 3%. So G will be representing the growth rate. Maybe 2% a year, 5% a year. So the company grows at 5%. Therefore, by the same logic, if the company grows at 5%, earnings will be able to grow at the same rate of 5%, and therefore, dividend will be able to grow at the same rate as 5%. So when we say the growth rate, it implies to the company size, to the revenue, to the earnings, to dividends, to everything. The whole company grows at this constant rate. Usually, this applies to mature companies. Mature companies. For example, a water company that's been in business for 10, 20, 30, 40 years will be, mature company will be, let's say, 100-year-old university in the United States. Of course, universities are non-profit institutions, but I'm just providing an example of some mature company, all right? Saudi Arabia will be certainly a very mature company. It's got, what, 50, 60, 70-year history, right? I mean, as a name, Saudi Arabia might be newer than that, but as a company, as a business, it is very, very mature company, all right?
Mature means old, and you mean old?
Mature means sufficiently old so that there are relatively little changes in the company. The growth is not as much, but there is no aging either. So it is relatively old, relatively stable. It is already very significant and is very difficult to grow at this point. I mean, how do you grow water consumption in Russia, Bulgaria, Saudi Arabia by 10 or 30%? You can't, because it's what was called a mature industry. Well, what will be an example? Cars are a mature industry, but fuel-efficient cars, hybrids, is what we call growth industry. So the opposite of mature will be growth. In a growth industry, you have rapid growth. An example of a growth industry will be flat screen or flat panel TVs, which are very modern now in Saudi Arabia. But they're very modern in America, they're very modern in Bulgaria, they're modern around the world, and now a lot of people throughout the world are replacing their ordinary TV sets with flat panel TVs. This was the same, let's say 5, 7, 10 years ago with flat panel LCD monitors. Monitors was a growth model, and everyone had a CRT monitor, and they were replacing it. Well, practically everybody now has a regular, LCD monitor now, and and LCD monitors is no longer a growth industry. It's a mature industry. 10, 15 years ago, laptops was a rapidly growing industry. Not anymore, all right? Right now, everybody's got a laptop. Very few people actually buy a desktop because, you know, there are few benefits, and the price differential, the premium you pay for a laptop is not big of a deal, right? So you might as well get a laptop. The point is, again, relatively mature industry. Is that fair to say?
It's like economies of scale or something.
No, it's not like economies of scale. It is like being able to grow significantly the revenue because of the nature of the business. You can't grow right now gasoline cars around the world. There isn't much of a demand. For diesels, there's a lot more demand. For hybrids, there's even more demand. For electric cars, they can hold a charge good enough for 200 kilometers or 200 miles. There is a potential as long as you can come up with the good, right electric car, like the Tesla or whatever, right? They beat the hell out of a Porsche, right? Right? Have you seen these videos?
No.
It's a tiny little small one. It just flies through and leaves behind the Porsche and the Lamborghini.
Ooh.
Oh yeah, oh yeah. But that is a growth industry. Right now, these Teslas are terribly expensive, $100,000 to $200,000, terribly expensive, and you still can't, drive them for a very long period of time. Still, can use maybe a couple of hundred kilometers. You can't make a trip to Bahrain yet, right? Because it's 400 kilometers. In the middle of the road, it's going to die on you. The batteries. But the point is, it has the potential to be used in town, Riyadh, and has the potential down the road, 1, 2, 3, 5, 8 years down the road, to be used for longer-term trips. But you got to understand, most of fuel consumption is used during downtown, in-town driving, city driving is where most of the gasoline is actually consumed. But these are growth industries as opposed to mature industries. Well, what about declining industries? Well, the CRT TV, which I was expecting, is a declining industry, all right? The CRT monitor is a declining industry. Regular film cameras,
Cassettes.
Yeah, cassettes, tape cassettes, video cassettes. Now everything's going digital. So all of these represent declining industries, all right? So you have mature, that's part from the previous chapter which you guys haven't read yet, right? Is about the industry, whether it's a mature or a growth industry or already industry in decline. So let's write out what's the present value. It is elementary, and we're going to get to your question. It's simply the dividend divided by R minus G, which implies that the growth rate can never be more than the required rate of return. Of course, the mathematics won't work out, but the reason is you can't have a 10 or 15 or 20% growth rate and you expect it forever. The problem is that the risk is extremely high. Which industry could possibly give you 50 years of growth of 10%? The risk in that growth is inherently extremely high. It's almost impossible to get, all right? So either the growth is unrealistically high or the risk is much higher. And even if it grows at 10%, it will require 12% required return, all right? So questions?
I will just comment, there's a graph for the company cycle that begins no growth.
Yes, it begins with no growth, and so we apply this graph, this graph for the stages of an industry, and we apply it also for the stages of a business. So you already have the graph for universities, but it will look very, very, very different from the graph of one particular university, which may be in its early stage and may be providing a better business model, or better technology, or better whatever, and may experience a growth which is competitors or peers. All right. So this is the constant growth model. It's a basic formula. Then the third level is so-called what I was giving the idea of two-stage growth model.
Is that the last model?
No, there's one last which I will be able to do. It's very simple. In a two-stage growth model, you assume that there will be G1 which will be higher, and then there will be G2 which will be lower. The G2 will be less associated. It's not in the textbook, but it's the best way to think about it is the long-term growth. And G1 will represent the short-term growth. Usually companies which are in their early stages will be experiencing very high, very rapid short-term growth, and as they mature, they will be switching to a long-term stable growth. In other words, they will have growth opportunities which they will exhaust. So this could last easily 5-10 years. Potentially could go as much as 15 or 20. In other words, the more complex the whole industry and the business, the higher the complexity, the higher will be, the longer will last the short-term opportunity. If the business is quick, simple, easy, straightforward, the short-term could be 1 or 2 years. All right? What will be a fairly short-term business will be opening a car repair garage. Of course, we're talking about one garage. And you get to mature your business, you hire the people, you establish the connection, the relationship, you build a customer base. All right? Which is going to be very different if you try to open a chain of 100 or 500 different auto repair shops under the same brand name and the same standard. All right. So this is the two-stage growth model. You use it mostly for growth companies that will mature but not yet. All right. And then the last one is, and you will see the formula. We use Excel for this, right? Back in the old days, it was done handwritten, right? Right now, you use Excel. So again, this is typically done by 25-year-old kids with no experience who know how to plug numbers in Excel. They learn it in Wall Street. And the last is a 3-stage.
Is it called hypergrowth?
No, just 3-stage. So, maybe Microsoft, in its early days, it will be growing at 25% annually, and as the whole world adopts Microsoft, it's going to have one rate. Then, it's going to be having a second growth rate instead of 25%. It's going to have more stable 15, and as it gets fully mature and has the competition of Linux, it may begin to grow with the growth of the whole industry and with the growth of the economy. So, first stage 25, second stage 15, and the third and mature stage will be, let's say, 7% growth. It requires different assumptions. Now, Wall Street loves these two methods, especially the 2-stage and the 3-stage methods, and it's very simple. Wall Street always likes to give its own customers good stocks. They do their evaluation with 2-stage and 3-stage models because by using these, by changing a little bit the assumptions of G1 and G2 and changing a little bit of these, in other words, the valuation is highly sensitive to G1, G2, and this Wall Street can easily manipulate the fair value of the stock and present it to investors as a great investment when in reality it's not. In other words, these 3 and 4 are subject to manipulation. They're subject to analyst abuse, and Wall Street exploits and abuses it very, very often. They call it sophistication. They use highly sophisticated, highly refined models, but most of the times it is used to manipulate and deceive investors into believing that the investment is better than it usually is. Question?
So these 4 models, do they like represent reality? Isn't there another model that says for the first year 20%, second year negative?
Well, these models, of course, don't represent reality because there is not a piece of reality. There are a number of things. Number 1, you have what is extremely common in the real world, because now we're switching to reality, called mismanagement. Mismanagement simply means that as the company grows and becomes prosperous, management becomes complacent. It believes that it has already conquered the world. This is what Lehman Brothers was, and all of those investment bankers who believed that the world was theirs. They believed that they're the masters of the universe and that the world was their slave, right? Well, once you get too complacent, you are not as sharp when it comes to execution, and usually the company goes into decline. Now, with a lot of great companies in the history of the world have gone into decline because management has gone really bad. Management can go bad for a different reason. The original guy, let's say Henry Ford, did it with passion, and he knew what he was doing. And he was great as a thinker, as a businessman. He cared about his people and whatnot. Now we know Ford is into bankruptcy proceedings. Now we know that Ford has been so many times on the verge of bankruptcy. Now we know that Ford has been terribly run for decades. Not 2 years, for decades. Well, same applies to GM and whatnot, right? You know, they're still trying to sell these big guzzling SUVs and whatnot. So there is a decline in management, the quality of management and whatnot. Sometimes the owners run it, and then management changes and whatnot. So this is always part of reality, and of course you cannot forecast that 5 or 15 or 25 years from now there's going to be mismanagement. Now, the second part, which is always present, is uncertainty, which I've explained has nothing to do with risk, is totally and completely unforecastable. Of course, we can estimate the probability for Israel nuclear attacking Iran or some other country, I don't know, nuclear war, but it's fundamentally uncertain. It's extremely difficult to estimate that probability. Earthquake, fundamentally difficult to forecast. Let's say global warming. The whole scientific community is viciously arguing if it's true, not true, human-based, not human-based, 5 years, 15 years, 20 years, whatever the global warming is. It is so disputable to the point of being unable to estimate uncertainty or the probabilities reasonably. And then again, even if you estimate the global warming effects, meaning how much the nature will warm up, you can't still estimate damages to the economy. And damages to Saudi economy versus the Chinese economy, the European, the Bulgarian, etc. economy. So there's a lot of uncertainty. And finally, there is that last thing which businessmen are now learning the hard way, which is the business cycle. most companies suffer irreparable damages during the business cycle, meaning during the downward portion of the business cycle, as they were mismanaged during the boom and have gotten deep into debt. Some of them go totally bankrupt. Others, throughout the business cycle, have gotten so high into debt that they must liquidate valuable assets in order to pay down the debt. So, you have a pharmaceutical company, you have 5 pharmaceutical whatever, you have 7 big blockbuster products, you've gotten too deep into them, you gotta sell 4 of these to your competitors to survive. You won't be able to recover 10, 20, maybe even 30 years down the road to recover from this damage where you lose most or best of your assets because you mismanaged your financial side or your liability side. Alright? This is good enough for today?
Great.
You guys happy? Alright, we're done.